We've spent the last several videos covering important fundamental definitions and topics to prepare us to discuss the underlying concepts of hedging a mortgage pipeline. In the last video, we discussed interest rate risk and the impact of market movement on mortgage-backed securities, TBAs, and on locked pipelines. So if you don't already have a solid foundation there, go back and check out that video first. In this video, we're going to use that information to introduce hedging and start to address things such as how do sales teams benefit from your company hedging internally? How does poor hedge performance impact sales teams and the company as a whole? And why should everyone in the company care about their hedge performance? My two primary goals when it comes to optimizing hedge performance on a mortgage pipeline are to capture and maintain as much margin as possible so the company can offer competitive and consistent pricing to the sales teams, and two, to protect the company from sustaining financial losses. Unfortunately, these things don't just happen because a company brings hedging in-house. In fact, hedging exposes a company to significantly increased financial risk if not managed properly. If a company loses money because of poor hedge performance, they'll often need to build that margin into the rate sheets, which can lead to frustratingly erratic pricing to the loan officers. In the worst case scenario, catastrophic hedge losses can result in a company shuttering completely, so hedging has some major implications. But when optimized, hedging also brings significant financial reward and enables companies to offer more consistent, competitive rate sheets and opportunities for loan officers to win more deals. So sales teams have a vested interest in companies hedging their pipelines and optimizing their hedge performance, as it can directly impact their business and ability to offer great rates to their customers. All right, so let's get into it. Hedging is the act of mitigating financial risk by taking an offsetting trade position in a related financial instrument. In this sense, it's a risk management technique used to reduce the threat of financial loss. Imagine you have an asset that's at risk of losing value if prevailing interest rates increase. By simultaneously taking an opposite position in a related financial instrument that gains value if rates increase, the financial impact of these market fluctuations can be neutralized. Put simply, you're offsetting losses from one asset with the gains of another. This reduces financial exposure related to market movement and thereby reduces the interest rate risk. Risk mitigation is the primary purpose of hedging a mortgage pipeline. The goal is to ensure that the profitability of the mortgage loans remains relatively stable regardless of interest rate movements. In the previous video, we explored the relationship between MBS, TBAs, and loans locked in a pipeline, highlighting their similar response to interest rates in different market movements. During a market rally where interest rates are decreasing, MBS, TBAs, and a locked pipeline tend to increase in value, resulting in a positive position. Conversely, in a sell-off where interest rates rise, their value decreases, leading to a negative position. However, short sellers of TBAs experience a loss during a market rally. That's because when they go to buy back TBAs that have increased in value, they're buying them back at a higher price. On the other hand, in a market sell-off, short sellers can see a gain by buying back the TBAs at a lower price. For example, let's say you sold short 10 million TBAs at a price of 104. As rates rise and prices decline, the value drops to 102 when you go to buy the position back, resulting in a $200,000 gain. Taking a short position on TBAs creates an opposing position in the movement of a locked pipeline in response to market fluctuations. This is how it can be used as a hedge instrument to protect a mortgage pipeline from interest rate risk. Before we move into an example of hedging, let's establish an understanding of commonly used terms when describing trading and hedge positions. Long and short positions are commonly used in both trading and hedging. But first, let's talk about trading. In an equities position, a long position refers to a holding of an asset, in this case a stock, with the expectation that its value will increase over time. Someone going long on a stock believes it will be worth more in the future and they will make money on that trade. Meanwhile, a short position refers to selling a financial instrument that is not owned, effectively the opposite of a long position, with the belief it will decrease in value. By taking a short position, the investor is trying to profit from a decline in the price of the asset. When trading, the goal is to make a profit based on market speculation. In other words, traders want to make money whether they're going long or short. So let's go over how long and short and other related terms are utilized specifically as they relate to hedging a locked pipeline with TBAs. These long and short positions don't necessarily reflect which position the lender is hoping will gain value. The goal is just that the long and short positions offset each other as closely as possible to result in a flat position. As the lender takes locks, they're taking a long position. These locked loans are basically a theoretical asset that the lender has, even though they haven't actually closed yet. Eventually, the loans that do close will have an underlying cash flow and most will become part of an MBS pool. To offset the long position of the locks, the hedger will take a short position on TBAs. The lender doesn't own TBAs, so they're essentially selling something they do not own, taking a negative position. The terms coverage and hedge coverage are both commonly used to refer to TBAs that were sold short. When lenders take a short position, it's often referred to as adding coverage because they're adding an offsetting position to the hedge value of the locks. When they need to reduce or buy back coverage, such as if loans are committed to be sold, locks are canceled, or if there's a significant shift in the value of the locked pipeline due to interest rate movement, the lender can buy back or lift coverage. Another common way of saying this is that they're covering their short to flatten their position. You'll also commonly hear about a position either being under or over hedged. If the value of a lender's locked pipeline is more than their hedge coverage, they're considered to be long, under hedged, or don't have enough hedge coverage. Remember, if rates go up, the value of the locked pipeline goes down. This underhedged position puts them at risk during a market sell-off because being long means they have more exposure to the asset that loses value in a higher rate environment. If a lender has more hedge coverage than the value of their locked pipeline, they're considered to be short, overhedged, or have too much hedge coverage. This puts them at risk if the market rallies. If rates go down, the gains on the locked pipeline can't offset the losses on the short position. TBAs are considered to be the financial instrument with the highest correlation to a locked pipeline. They typically have lower overall basis risk, which refers to the mismatch or divergence of the hedged instrument to the asset being hedged. But while TBAs are by far the most common way to hedge against mortgage interest rate risk, especially for short and medium-term hedging, examples of other potential hedge instruments include options on MBS or treasuries, swaps, swaptions, or treasury futures, to name a few. Option contracts, which we'll cover in much more detail in a later video, typically have higher costs compared to TBAs, lower liquidity, and their availability is often limited to shorter durations. Treasury futures may experience price movements that diverge significantly from MBS because of movements in prepayment risk or changes in relative supply, causing a poor correlation. Since TBAs on MBS tend to be the most effective instrument and are by far the most common, that's where we're going to continue to focus most of our future discussions. All right, let's pull all this information together with a scenario. Imagine the market interest rate for a 30-year fixed conventional mortgage is 4.5% and a lender locks $10 million worth of loans, all at a price of 103. At the end of the lock period, market interest rates have increased to 5%, and now investors are only willing to pay 101.5 for loans with a 4.5 rate. Originally worth 103, they're now worth 1.5 points less to price. Remember, the lender can't pass that margin loss onto the lock-protected borrower, so the originator is stuck taking a loss on the position and selling the loans at a lower market price than expected on the lock date, in this case amounting to a $150,000 loss. But on the same day they took $10 million in locks, the lender called a broker-dealer and sold $10 million in UMBS 4s into the futures market at a price of 103, effectively taking a negative $10 million position. In 30 days, when the market price for those TBAs dropped to 101.5, they decide to exit their short position and buy back the TBA from the broker-dealer. This buy will flatten their position, returning their short position to zero, and will result in a $150,000 gain on the trade. So in this example, the $150,000 gain on the trade effectively offset the $150,000 loss on the locked pipeline. While this is oversimplified, this example is meant to illustrate the basic mechanics of how mortgage interest rate risk is typically managed by lenders. To manage a locked pipeline, the hedger will adjust their position daily by either adding or lifting coverage to accommodate any changes in the value of the locks, trying to ensure their overall position remains as flat as possible. What I can't stress enough is that while the value of the short position and the value of the locked pipeline respond to changes in interest rates in opposite directions, they do not have a one-to-one correlation. This is especially true of loans that are early in stage in the locked pipeline compared to loans that are hedged after closing. For example, imagine a lender has a $110 million pipeline based on volume of the underlying locks. Let's say 100 million of those locks are still applications being processed, while 10 million of these are loans that have recently closed. For the 100 million of locked applications, we know not all of those will ultimately close, and of the loans that do close, not all will close with their original day one margin. Borrowers may cancel the lock because of issues with the property or the sales contract, they may leave for another lender, or they could request a lower rate at the cost of the lender. So why does this matter? To accurately apply coverage, the hedger needs to try to estimate what the true value of the pipeline is at any given time. If They apply 100 million worth of coverage to a pipeline where only 80 million of the loans are likely to close, they'll be overhedged. And that's before we account for any reductions to margins some loans may experience due to things like renegotiation and other factors impacting the total margin to the lender. In contrast to the locked applications, the 10 million of closed loans are not at risk of failing to close. So in this case, the 10 million are actual loans. However, even in the case where the volume of underlying loans will remain the same, they still may be subject to other price and margin considerations that don't correlate directly to the price of a TBA, so they still don't have a one-to-one relationship. This concept will be extremely important when we talk about hedge ratios and how price sensitivities are applied in a future video. Hedgers rely on modeling and predictive analytics to analyze the dynamics between the value of the locked pipeline and the value of a hedge. These tools provide critical insights into how the relationship between the two may be influenced by different interest rate environments and what the ratio of locks to coverage should be at any given time. This helps hedgers make informed decisions regarding their hedge strategies and how they need to adjust their position. However, and this is critical because models rely on historical data and predictable behavior, even a world-class hedge model will have difficulty performing well if there are too many variables in customer or loan officer behavior during the loan process. However, we'll talk more about this when we discuss lock policies and procedures in a later video. Let's take a minute to distinguish speculative trading from hedging as it relates to the mortgage pipeline. Speculative trading involves traders aiming to make profits on the hedge pipeline by intentionally taking a long or short position based on their predictions of market movements. Essentially, they make educated guesses about the market's future direction and act accordingly to capitalize on potential gains. However, this approach can be likened to betting on the market, and it comes with a substantial level of risk. Lenders who engage in speculative trading can jeopardize their relationships with their counterparties, such as broker-dealers, investors, and warehouse facilities. These stakeholders often have policies against speculative trading due to its inherent risk, and this can be grounds to terminate the relationship with the lender. Furthermore, the unpredictable nature and lack of consistency associated with speculative trading means that if a lender makes incorrect predictions, they may need to compensate for their losses by baking an additional margin into their rate sheets. I can't emphasize enough that with hedging, the primary goal is to offset financial risk, not to profit from the hedge. In fact, in a perfectly hedged position, any gains would be equally offset by losses. Of course, you'll never see a perfectly flat position when hedging a mortgage pipeline, but you do want the results of the hedging to be as flat as possible. So the next question might be, if you're not trying to profit from the hedge, why would lenders want to take on this interest rate risk? One major benefit of internally hedging a pipeline for lenders selling to the aggregators and not pulling 100% of their production is that the lender can often sell closed loans on a mandatory basis at a higher price compared to the day one best efforts price. The price difference is typically referred to as the best efforts mandatory spread, and the gains from these payups can be significant. For lenders not using best efforts pricing, but deriving the rate sheets from MBS or cash window pricing, the payup between the day one price and the price at sale is typically referred to as the secondary spread. These margin gains are typically used to offer improved pricing on rate sheets and can be used to reinvest in other important initiatives like marketing and technology to help originators remain competitive. However, to reap the maximum benefit of internally hedging and see consistent, predictable hedge results and rate sheet pricing, it requires a collaborative effort from secondary, sales, and operations. Another benefit of having an internally hedged pipeline is that it allows lenders to create their own uniform policies around locks, so they aren't beholden to the inconsistent policies of all their investors. Finally, for lenders who securitize, internally hedging their pipeline is a requirement. Our goal in this video is to establish a baseline understanding of hedging and how important it is for neutralizing the company's exposure to interest rate risk. One of the things we've mentioned several times is that while TBAs are the instrument of choice for hedging a mortgage pipeline, they do not have a one-to-one correlation, and the volume of the pull-through weighted locked pipeline can't simply be hedged by selling short an equal amount of TBAs. But if there's not a one-to-one correlation, how do hedgers determine how much TBA coverage to apply? What happens if they're wrong? And how can business practices contribute to the wrong coverage being applied? And most importantly, how can secondary and sales work together to reduce the risk of this happening? We'll be exploring all these questions and more as we dive into locks in an upcoming video. Thank you for joining us on this brief introduction to hedging. We've got a lot to cover coming up, including insights on rate locks, rate sheet pricing, servicing, and many other great topics as we work to address the most common question sales teams have for secondary.